Good morning, everybody. It's an absolute pleasure to be here, and I'm really pleased to be joining you for today's symposium. It combines two topics that are very close to my heart: family business and corporate governance. I often say that good business done well is a force for good in society, and good governance is really the foundation of good business. Family businesses, especially those that have made the transition to the second generation of ownership and beyond, have an innate sense of this. Most family business owners, myself included, view ourselves as custodians. We are stewards of our businesses, and our long-term aim is to pass on to the next generation a stronger, more sustainable enterprise. I would argue that we can't do that without good corporate governance. The word governance itself originally comes from the Greek word kubernetes, which is the steersman of a ship. I think this is quite a helpful metaphor. Every ship, no matter how small, needs to be steered. Without steering, no vessel can reach its destination. The Wates corporate governance principles for large private companies, which I'll say more about later, were designed with family businesses and private businesses in mind, to provide them with a map by which they can steer their ships, not just for the sake of reporting, but for the sake of learning and improving, for the sake of developing the right sort of transparency that can lead to greater levels of trust in individual companies and in business as a whole. Whenever there is a major corporate scandal or failure of an important company, the government faces pressure to be seen to do something. The media, in pursuit of a juicy story, can pile on the pressure. There can be a perception that all of business is rotten and that the only solution is for government to step in and regulate. So in my view, there are two faulty assumptions. First, that business is incapable of resolving its own problems. And second, that government can possibly solve the problem by regulating. I can't deny that there are some bad apples in the corporate tree. Their stories are well covered in the media, but a few examples do not make a trend. Perhaps this is an area for further research. Just how many private companies collapse as a result of bad governance? And what's the impact on stakeholders? What proportion of these failures or scandals involve family businesses? What's the real impact beyond the media headlines? We would benefit from some strong guidance to help the government understand the scope of the problem, which I suspect is smaller than some would like us to believe. We need evidence to demonstrate that the disproportionate cost of regulation compared to the real risks. Because we've seen in the past that when government steps in and adds further regulation, it ends up creating more unintended consequences than actually solving the problems. I believe that the best solutions are those which are developed by business, for business. And the solutions which have the greatest effect are those that impact directly on the way that business is run. Window dressing doesn't solve anything, but good corporate governance does. That's up to us, business leaders, to implement. We can't wait around for someone to do this to us. Government does have a role in creating the right environment for business, but it is business that creates wealth through taxes, that the investment, which if properly managed by the politicians, leads to a fairer and more prosperous society. At my company's AGM every year, I proudly tell our shareholders how much tax we pay during the year. After all, paying tax is an essential part of citizenship, and companies should not be excluded from this responsibility. Her Majesty's Treasury depends on our success. 1/4 of the UK's tax revenue comes from corporation tax and VAT. That's value generated by business. Another 20% of the government's income comes from income tax paid by our employees, and a further 15% in national insurance contributions from business. Government's role is to take the taxes and invest them to ensure social equity. In the favourite phrase of this government, levelling up. So in early 2018, the then Secretary of State, Greg Clark, asked me to chair a review of corporate governance. When he asked me to do that, I took on the challenge. It wasn't a simple decision, actually. My first thought that this was going to be another example of government imposing yet more regulation, and that would be yet another burden on business, and would end up resulting in the dreaded unintended consequences, rather than actually solving the problem. But then I considered that this was actually an opportunity to shape the process from within and create something that was an opportunity for business to shine rather than yet another burden. A group of organisations was already assembled, representing the so-called coalition group. This included the CBI and TUC, Not Normal Bedfellows, as well as other various organisations specialising in business ethics and governance. Of course, family businesses were prominently represented in that group through the participation of the IFB. The Financial Reporting Council served as our secretariat. When the group came together, we all wanted to create something that would really make a difference. This meant developing some principles for corporate governance that were both challenging and able to be applied by just about any organisation. I wanted them to serve as a mirror that any company could hold up to itself to see how it is doing. I also wanted them to provide a framework for companies to use in communicating transparently with their stakeholders, rather than just ticking certain boxes for regulations. Of course, through the whole process, in the back of my mind, was the concern that whatever solution we came up with, it had to be something that the company I chair, the Wates Group, could not just report against, but more importantly, apply and benefit from. And with the big picture in mind, our ultimate goal was to help improve the trust that stakeholders have in companies. We know that trust in all types of organisations is low, but our hope was that by creating a new framework for improving transparency, we would strengthen that trust with the public, or with that trust that the public has in business. The principles have been available for more than 3 years now, but it may be helpful to have a quick look through the substance and see, as you see on this slide. If you're not familiar with them, I will just read through the principles as they stand. At the top of the pyramid is purpose. An effective board develops and promotes the purpose of a company and ensures that its value, strategy, and culture align with that purpose. Underpinning that in the second tier is board composition. Effective board composition requires an effective chair and a balance of skills, backgrounds, experience, and knowledge, with individual directors having sufficient capacity to make a valuable contribution. The size of a board should be guided by the scale and complexity of the company. Big boards are not necessarily best, nor are small boards. Director responsibilities. The board and individual directors should have a clear understanding of their accountability and responsibilities. The board's policies and procedures should support effective decision-making and independent challenge. And I think that's incredibly important. Underpinning the whole of it at the bottom foundation of the pyramid, if you like, is opportunity and risk. A board should promote the long-term sustainable success of the company by identifying opportunities to create and preserve value, and establishing oversight for the identification and mitigation of risks. Remuneration. A board should promote executive remuneration structure aligned to the long-term sustainable success of a company, taking into account pay and conditions elsewhere in the company, and indeed the sector. Stakeholder relationships and engagement, which I think is a fundamentally important piece. Directors should foster effective stakeholder relationships aligned to the company's purpose. The board is responsible for overseeing meaningful engagement with stakeholders, including the workforce, and having regard to their views when taking decisions. So where are we now? To recap on the legal context, legislation was enacted in 2018 that requires large private companies, which of course includes family-owned businesses, to include a corporate governance statement in their directors' reports. The legislation applies to private companies, with either more than 2,000 employees or a turnover of more than £200 million and a balance sheet of more than £2 billion. Keep in mind that when I say private companies, that includes those that are owned by individuals, families, or private equity. And it also includes wholly owned subsidiaries, whether the parent company is in the UK or elsewhere. But the legislation doesn't require companies to use the Wates principles. companies can use another code if they so wish, such as the UK Corporate Governance Code for premium listed companies. If companies have their own corporate governance code, they can use that, so long as they declare it and report on it. The legislation took effect for reporting years beginning after the 1st of January 2019. Normally, we would have seen directors' reports coming through in early and mid-2020. But of course, the dreaded COVID came along and slowed everything down. So it wasn't really until this time last year that we could start to develop the initial picture of how these were being taken up. And then in the middle of last year, with a good supply of reports published, the FRC commissioned research on the take-up of the Wates principles. And that research is now very close to being published. It's still too early to draw many conclusions, with some companies having published only one report against the Wates principles. But the research provides us with rigorous analysis that we need in order to inform ongoing government policy decisions about corporate governance. You'll probably have heard about the range of governance reforms that the government published last year. There were some very worrying proposals floated, particularly with regard to broadening the category of public interest entities, particularly of a particular size. So my hope was that research would help show that further regulation is not needed. Unfortunately, I'm not sure that the government, as ever, is listening. Nonetheless, I'm pleased with how many companies are grasping the spirit of the Wates principles in their governance reporting. This means they are using principles as a tool for self-reflection and improvement, and they are seeing the yearly governance reporting as an opportunity, not a burden. Many companies are clearly seeking not just to tick boxes, but to communicate to their stakeholders relevant information on how they are governed with an appropriate level of detail and through clear and understandable language. So let's start with some very big picture of what the research has found. A very big picture. Of about 800 companies that published a corporate governance statement, slightly more than half, 454 in fact, applied an existing corporate governance code. I'm pleased that the Wates principles were the most widely adopted corporate governance code for large private companies, with 348 companies adopting them. This equates to more than 3/4 of all companies that applied an existing corporate governance code. Other codes that companies follow include the UK Corporate Governance Code, of course, which was 87 companies, and various industry-specific codes, such as in the utilities sector. This slide is a somewhat crude comparison of reporting against the 6 principles, but it serves as a foundation to make a few key points about learnings. In assessing how well companies reported against each of the 6 principles, the researchers set some very ambitious criteria. This means it was practically impossible for any company to get 100% marks, even my own, which was incredibly frustrating. Take, for example, Principle 4, Opportunity and Risk. This featured the highest numbers, with one company scoring over 80%, and the average around 40%. As you can see reflected on this chart, which illustrates the challenging criteria, I'm pleased here that many companies did not just focus on risk, but also provided detail on how they identify opportunities. Principle 1, Purpose and Leadership, had the weakest scores, which is surprising, with an average score of less than 20%, but a top score of nearly 60%. Here I think it's right to challenge companies to be more concrete in how they talk about purpose. Companies were good at listing their values, but less good at explaining what they actually mean, and how board members are going around promoting them. It's important to note here that many companies struggle when reporting on purpose. Previous research by FRC showed that premium listed companies have a lot to learn about reporting on progress. Looking at the whole picture, the researchers pointed out that companies need to be better at cross-referencing from the corporate governance report to other parts of their annual report. It's not necessary to include huge amounts of detail in the government's report, which could make it unreadable. But at least they should refer readers to specifically where more detail is available. On the positive side, some companies are doing well in citing examples of actually being discussed at board level, not just using boilerplate generic text. but using real examples to give the reader a full picture. So I'm pleased that some of the good reporting, to see some of the good reporting coming through. You'll be able to find out more detail in the FRC's report, which will not just provide more data on the company's performance, but will also offer insights into how they can improve. And of course, it will explain the methodology used. The report will be available on the FRC website in a few weeks' time, I'm told. Now, all of that reporting is happening within a context that is continually changing. There has been a government review of Financial Reporting Council, and they are being given a broader remit, with a clearer focus on governance and accompanying resources. The government is poised to follow up on its corporate governance consultation paper from last year, and we will probably see some, frankly, unhelpful expansion of the regime around public interest entities, and that would cover private companies. The government was supposed to reveal more in January, but I somewhat suspect their attention has been focused elsewhere. Even without interventions, it's already quite a complex reporting environment, with varied thresholds to different types of reporting, such as, for example, pay, gender pay gaps, invoice payment, performance, and so forth. It's very fashionable for companies to talk about purpose and their commitments to working towards net zero. But drawing some conclusions from greenwashing and trying to dress up their business as being more socially beneficial than it actually is a challenge. And as we saw in the research on the Wates Principles reporting, explanations of company purpose are often lacking specifics. Many people ask me about how the Wates Principles relate to sustainability issues, or to Section 172 reporting. If we think about the bigger picture of ESG, environmental, social and governance reporting, we should recognise that there are some overlaps. ESG concerns are a collection of interrelated elements. I put the G for governance here at the top of this diagram, because I see it as the top of the pyramid, setting the structure and tone for effective reporting on environmental and social topics that come underneath it, equally important nonetheless. Regardless of how you visualise it, every company will be caught by different regulatory requirements, and it can be a very complex picture. The Wates Principles do not explicitly ask for reporting on environmental impact, but the broader concept of long-term sustainability is baked into everything. We had representatives of the Climate Disclosure Standards Board in our coalition group, and they helped us to ensure, at the very least, that there was nothing in the Wates Principles that would run counter to good practice in environmental impact reporting. There is also guidance which says, when explaining impact on the community or environment, boards may want to refer to recognised international standards or frameworks. In other words, don't reinvent the wheel. Use existing standards as your reference points, and the reporting should cross-reference these. Cross-referencing, again, is one of the areas that the FRC research focuses on. Companies did fairly well in cross-referencing their Principle 6 to Section 72 reports, but this can be improved. We at the Wates Group, not surprisingly, were early adopters. So we're now working on our 4th corporate governance report using the Wates Principles, but there is still much to learn, and we continue to ask ourselves questions such as, how much detail do we put in? Do we provide numbers showing how we are performing against some of our targets? Or is it sufficient just to outline the direction of travel? We know that specifics really make the reporting come alive, and they make the report a unique item to our own business. But too much detail will be overload, especially when you think there are a range of audience who will be reading the report. How to balance old versus new information. In the first year, we described some of our existing governance structures and systems, but that remains broadly the same year to year. So in later years, we've simply cross-referenced to other sources of information about this evergreen material. We focus on reporting what is new in the given year, but there needs to be a balance so that anybody can pick up the report and understand it. I don't profess to have the final word on how to report on the Wates Principles, but a lot of people do ask me for my advice. So my tips are, be brief. My aspiration was to keep our statement to one page. I was willing to settle for 2. It ended up being 4. We'll keep trying to do better, but there's pressure from the people in the business to say what great things we're doing, and it's likely to get bigger, but we've got to really maintain that. We need to speak in a language that everyone can understand. The research showed that many of the reports scored poorly on reliable readability indices. However, the corporate governance statement should be an opportunity to build trust with the stakeholders who matter to the company. Companies should not be trying to impress. They should be writing to connect to their employees, and customers, their business partners, and the communities. Genuinely apply the Wates principles. To apply the principles, you can't do it at the end of the year. Throughout the year, at every board meeting, companies need to be capturing what they've done and what is relevant to corporate governance. You need to make it routine, like putting on a seatbelt. Look beyond reporting. The Coalition Group and I wanted the Wates principles not just to guide annual reporting, but to inspire better corporate governance. When companies apply the Wates principles, they will find areas where they are strong and areas where they are not so strong. They should shout about the strengths, but recognise that no amount of wordsmithing will cover up the deficiencies. So ultimately, this is about real, honest transparency. No company is perfect, and corporate reporting should not pretend otherwise. If we really want to foster stronger trust in our companies, we need to be transparent about our corporate governance, how we are actually run. So where next for the Wates principles? The Coalition Group will have a closer look at the research results in the coming months and consider the lessons we've learned. We may think about whether we need to more explicitly refer to the E part of ESG and promote strong environmental impact reporting. We may want to actively encourage companies to consider the good practice that the research has identified around cross-referencing, and using more concrete examples from the boardroom to illustrate key points. The environment is ripe for delving into how family businesses in particular are using the Wates principles. I've heard some concern that family businesses are now trailing behind the listed sector in ESG reporting, and there may be an opportunity for the family business community to come up with its own solutions that are right for our own particular circumstances. Meanwhile, the Coalition Group and I are keen to hear from anyone with insights on how companies are applying the Wates principles. Companies are still learning, so we have an opportunity now to drive good practice for the benefit of the whole business community. Thank you again for giving me the opportunity to talk to you today, and I think there is time for questions either from the room or from the ether. Thank you very much.
Any questions, anybody, for James?
Yeah, hi there.
In terms of the private equity interest, there's a lot of PE activity going on. Does that have an impact in terms of governance, in terms of the private listed companies or private companies?
And interesting, there's a lot of people who perceive the private equity world as being the Wild West. They were an important constituent part of the Coalition Group through the British Venture Capital Association. And there was one particular private equity chairman who was very, very keen that it was taken into all the companies that were in his portfolio. Because he said, we've got to demonstrate good governance. We've got to show that we are actually proper members of the business community, and you know, we are doing things properly, because an awful lot of them do. So it is very relevant for private equity. They are private companies. They are covered by the legislations. Michael?
James, when we did the research, our previous research on governance, it was actually pretty hard to find data on family businesses in terms of whether, for example, directors were members of the controlling family or not. Because of course they may have a different surname, it may be hard to find links. Do you think that the data for research is going to be more consistent and transparent coming now the Wates principles are becoming embedded?
I suppose you would hope that would be a byproduct. It wasn't a driver, but as a byproduct, I'm not sure why anybody would try to be anything other than transparent. about it. I mean, to me, transparency is
So
crucial.
when I read the Wates account, report, will I be able to tell which of the directors are the greater extended Wates family linked and which aren't?
Yeah, we're quite easy. We're all called Wates.
Today.
Today. In 15, 20 years' time, as the next generation start coming in, who might well have married surnames that are different, I suspect you wouldn't see it. Would they be on the operating boards? Possibly not. So that wouldn't necessarily be. They might be on a holding board. Equally, if you do a good report on accounts, you're going to have the biog in there, and everybody has their biog. So I would hope you might pick it up. But I think each family is different in how they like to maintain their association.
And I guess it's a follow-up question, quick one, is some of the big issues that we've seen in sort of Philip Green's world and others, do you think that applying the Wates principle would have helped pick those up earlier, or do you think the pressure on accountants to not get caught out doing core audits is going to have more effect and actually stopping the really big ones that damage the reputation of all our business?
I think it ultimately comes down to the culture of the business, and if you have in inverted commas, rotten culture, and you're going to try and be obscure about the way you do things, then the best principles in the world, the best regulation in the world, people will find ways around it. So I think the audit profession has a role to play, absolutely, to ensure that audits are thorough and clean and proper. Equally, I would hope that directors take on their responsibilities to make sure that is the case. But a bad apple is a bad apple. If they decide to do something, then it needs people to be able to forensically dig. And the best principles in the world, I think, will struggle to cover. What it will do, I hope, is inspire others to raise their game. Seeing inspiring winners on the backdrop over there, I think it makes you think the winning companies will be the ones that are inspired and are the best. That's one there, yeah?
Extending the previous question, I'm wondering how does the family governance stand at the Wates company, and how do you articulate between family governance and corporate governance principles?
Okay, a very good question. So in our business, we have what we call governing owners, and that's the five of my generation who are actively involved in the day-to-day of the company's affairs, so the business affairs. And we all currently sit on our main operating group board. We also have a family council, which is where we communicate with our broader shareholder base, so our retired shareholders, and as they come into the business, future shareholders. So there's a communication going on there. But at the moment, we do have a unitary board, so it is the family board with executives, and our independent non-executives actually are the governing board for our business. Any more in the room? Louise.
I was just thinking, given the importance of climate change to all of us now, maybe this is a real opportunity for you to find out what family businesses are doing in that respect. If the E is part of ESG and that's all part of governance. But I'm just thinking, how do we get that message across somehow if that message isn't getting across? It probably is getting across because nobody doesn't know about global warming.
Yeah.
But how do you think you can persuade companies to take more account of that in your position, and perhaps Michael Bigby's position going forward?
Well, I think it comes down to leadership and walking the talk. So by demonstrably doing the right sort of thing, absolutely, and having a business that is focused on this. So the Wates Group has made a commitment to net zero from operations on scope 1 and scope 2, to be fair, by 2025, which is very close. It's only 3 years away. We're on the journey. We don't necessarily know how we're going to get there, but unless we reach for it, we're going to struggle to make any impact. So we've put out a bold statement. Others are more cautious and looking at 2030, which is more in line with government policy. but I think if you want to be a winner, you've got to be ahead of the game. So that's why we want to do it. So I think in terms of how you do it and demonstrably being good at it, I think others can then follow. Equally, I think there is, as I said in my words there, I think there will be an increasing focus on the E, and I think as we look as the coalition group at the research that's come back from the reporting on the Wates principles, I think we'll start to see what sort of things are coming through, and maybe our steer will be, because the climate standards board are part of our group, how we can actually get that reporting to perhaps be a little bit more focused, because it is critically important.
And do you think that down the line that might involve some kind of legislation? I know you're saying it doesn't necessarily work for companies bringing in legislation when they could actually do that themselves, but do you think in this case it might get more critical, essentially?
It's interesting. It's a carrot and stick thing. I think a stick can be very, very misguided because it can force the wrong behaviours. To have carrots that encourage people to do things, I think is good. And if I look at, whilst I don't think the government's got it right, if you look at the farming sector and the move away from the basic payment farm scheme to more environmentally focused schemes, I think that will be challenging for a lot of farmers, but it might well make a difference. And I think that is more of a carrot than the regulatory stick that could actually, could really force farmers to be unable to do what they do effectively. And it's always getting that balance between doing good business, doing it right, but doing it with a view to what's important for the future.
Yeah, thank you.
Yes?
I was just going to ask about supply chain and your business practices and how you use those to drive good governance principles as the relationships you build and what you're seeking in organisations that you work with.
Okay. So, I mean, in our industry, in our business particularly, supply chain is critically important. We are very much managers of the process. We put all the resources together, but it's subcontractors who actually do the delivery on site. It's suppliers who provide the materials that we build. So they're critically important components of our success. So we do work with a very an increasingly tight bunch of higher quality suppliers and subcontractors, and they have to be aligned to what we're trying to do in terms of environmental activity. They've had to do it for years on health and safety. If they didn't comply with the health and safety standards, they wouldn't work on our sites. So the same will apply to environmental standards and such like going forward. So we can influence incredibly well, but we can also learn a lot from them, because they don't just work for us, they work for other contractors and other firms. So it's good to get an insight into what the world is doing, and that feeds back into us and hopefully makes us better.
I think we've got time for one more question, possibly, before the break. Anybody online? Is there anybody online or in the house?
One at the back there.
Yeah.
These principles, how you talk about the operational board and you talk about holding board. If you were to distinguish some of these principles, how they might apply slightly differently, I would assume maybe principle 4 is more applied at the operational level, but I don't know how you might distinguish. Just talk a bit about how the 6 principles you went through before might apply slightly differently.
Okay. I mean, I can see there would be different emphasis, perhaps. So, I mean, if we would take our business and we take the group level, I think the 6 principles as they stand are all very relevant to us. You then drill down to our operating businesses. So let's take our construction company, for example, which has its own board, but it is under the scale that it has to report against principles, although it's wholly owned subsidiary. But if they did have to, purpose and leadership, that would be important to them, but that is to a great extent set by the ultimate board. Board composition is very much driven from the top board, and that's imposed on them broadly. Director responsibilities, they have their director responsibilities. That is the same for every business. I think opportunity and risk is one that they would be much more focused on at a more micro level than a group board would at a macro level, but I think it's still very relevant to them. Remuneration is an interesting one. I think below board level, the construction company would be very much focused on its remuneration for its people, but the senior people, the senior executives in that business, would be part of the group remuneration consideration. So that one would be a slightly greyer area. Stakeholder engagement, I think, is very relevant to operating businesses, as indeed to the top co. So I think they all apply, but with maybe different emphases, is how I see it. Louise, thank you.
Okay, yeah, I can't see any questions.